Are you ready to rumble? Vanguard and Fidelity. They're going to duke it out. From Duke, as a matter of fact. How ironic. Vanguard versus Fidelity. Comparison of the index funds and ETFs of the two largest fund families. All right. So we got a couple of familiar with Ed Tower. Not familiar with Rona Zhang or Chong Li. Sichuan University is Chong, and Rona Zhang is a North Carolina School of Science and Math. I don't know. I'm not sure what that is. But anyway, I'm familiar with Ed Tower. So the Economic Research Initiatives at Duke, the Working Paper Series, and there's their identity there, erudition and religion. So that's something, probably truth and religion. You've got a cross in there. Isn't that weird? That just weird how the university was all based on Christianity, and now they're just they flee from it as if Christianity led them to be anti-science, and yet Christianity is what allowed these universities to exist to begin with. Strange. All right, so let's read about this. We got Lee as a PhD candidate at Sichuan University and a visiting scholar at Duke. Tower is the professor of economics at Duke and a long-term visiting professor at someplace in, I guess, China. Zhang is a senior at the North Carolina School of Science and Math and will be a freshman at Northwestern. All right. Abstract. This paper compares Fidelity and Vanguard on 21 comparable funds in 5 aspects: performance, tax efficiency, cost, diversification, benchmark, and tracking precision. The conclusions are as follows. Okay, so here. So what is your take? Who's going to win? Vanguard or Fidelity? Put it in the comments. I'm going to tell you I think it's going to be Vanguard. I haven't read the paper yet, but I just think it's going to be, so let's see. The difference between them, pre-tax return is small, but Vanguard is a clear winner in after-tax return. Interesting. Second, Vanguard is much more tax efficient than Fidelity. Third, for the cost, Fidelity has lower expense ratio than Vanguard in all sample funds, while Vanguard has lower turnover, which would lead to the better after-tax, more tax efficient and after-tax return. Both Vanguard and Fidelity have their own short-term redemption fee policy. Vanguard funds are more diversified and should reduce uncompensated risk, and Fidelity funds have higher tracking precision. All right, but the difference is small. In 2004, Zhang and Tower wrote a paper comparing the performance of the two largest mutual funds, Vanguard and Fidelity, over a long horizon. The U.S. fund industry has changed dramatically, as shown in Exhibit 1 to Exhibit 3, according to data from the investment company Fatbook. The number and total net assets of mutual funds rose rapidly while the fund's expense ratios have dropped sharply. At the same time, in Exhibit 4, since 2000, the share of Americans owning mutual funds has risen and remained above 40%, indicating that mutual fund investments play an important role in the asset allocation of American households. All right, so there's a number of mutual funds from 1997 to 2017, so that's a lot. Total net assets, let's make this bigger here. Total net assets of U.S. registered mutual funds, 1998 is 5.53 trillion, and now it's 18.75 trillion. Man, that's nuts, man. That's crazy. Let's see. Here the expense ratios have dropped from 0.99 to equity to 0.59 equity funds. Hybrids are down from 0.89 to 0.7, and bond mutual funds 0.76 to 0.48. And that's a good chart, but don't be caught unawares that if you take out the index funds, the fees are still quite high for equity mutual funds and bond funds. So when you put in the whole and you're throwing the index funds in there, it's going to skew the total fees across the board lower, but it doesn't skew the fact that actively managed funds are still just doggone expensive. No other way around that, other than American funds. All right, let's keep going. Share of households, only 44% of households own some kind of mutual fund in 2017. All right. In 2004, Vanguard touted its low expense and corporate governance structure, i.e. they're owned by their shareholders, while Fidelity touted its stock pick and research prowess. But Fidelity's funds expenses were typically higher. Over the past 15 years, the fund industry, especially Fidelity, has seen the expense ratios fall a lot because of the so-called Vanguard effect. There you go. John Bogle has saved countless tolls Americans just billions of dollars. Low expenses have become a source of pride for Fidelity, and in August and September, Fidelity even launched 4 zero expense ratio index funds. So it's worth comparing the two giants of the industry 15 years later. This paper aims to give investors some help by comparing the two. All right, so let's see. In these two exhibits, a blue cell indicates victory. Specifically, victory means higher return, lower tax costs, lower expense ratio, higher tracking precision, higher diversification, and lower turnover. So blue is a win, yellow indicates a draw, and a crimson and V in average Vanguard minus Fidelity indicates Vanguard wins, and a green number F. Okay, gotcha. So a crimson and a V indicate a Vanguard win. A green and an F indicate a Fidelity win. Because the logo of Vanguard's colored crimson, the logo of Fidelity's green. Okay, cool. So let's take a look. So here we get, remember, blue is a winner for Vanguard. Or blue's a winner, that's right. So we got blue is a winner, yellow is a draw. So domestic stock index funds, here's Vanguard Admiral Index, and here's Fidelity. So the expense ratio, Fidelity wins. How does Fidelity win that? 0.015. Okay, yeah, I gotcha. Well, I mean, by this time it's a race to the bottom. It's no big deal. So Fidelity 500 index fund versus Vanguard S&P 500. Fidelity wins on expense ratio and okay, I see how they're doing this. Oh, this is pretty cool. I like this. Let's see if I can't make this bigger. All right, so here it goes. Here's a Vanguard 500 fund compared to the Fidelity 500 index fund. Vanguard wins in everything after tax return, tax cost. Fidelity wins in expense ratio and before tax return. Isn't that interesting? And the before tax return is 13.1 for Vanguard and 13.11 for Fidelity. The after tax return is 12.63 for Vanguard, 12.57 for Fidelity. The tax cost is 0.47 for Vanguard and 0.54 for Fidelity. So even though the expense ratio is lower, Vanguard does better. All right, cool. This is a total stock index, I imagine. Yeah, it'd be roughly the same thing. Other than expense ratio, Vanguard wins across the board. So that's there you go, man. That's pretty cool. All right, so Vanguard and total stock and Fidelity, Vanguard wins both the total stock and the S&P 500 index. Here we got extended market index. Vanguard wins mostly, except for a couple areas. One's a draw, and then the pre-tax return, Fidelity wins for 3 and 5 years. So Vanguard, again, of the domestic index, Vanguard wins going away. There's no other way around that. And I say going away, we're still talking pretty minimal difference here. Vanguard Growth Index Fund, Value, and this is why I own the Vanguard Value Index Fund. And it looks like Vanguard wins on what's this? After tax okay, so pretty doggone close here. Okay, Fidelity doesn't have much. So Fidelity doesn't have much of a track record to compare. All right, so that's what I own, the Vanguard Value Index Fund. All right, let's see where Fidelity wins. We'll see, Fidelity doesn't have that much of a track record to speak of here. Yeah, so Fidelity only goes 5 years. So until Fidelity has more of a track record, I think you got to go Vanguard. Without question, I mean, just look at this blue. So, and I mean, just look, the Fidelity's expense ratios are lower, so they can tout their lower expense ratios. Pretty good marketing ploy, but everything else is in favor of Vanguard. I mean, just look at that. It doesn't come close. And the fact that Fidelity doesn't have 10 years, Vanguard would wipe them up. There's no other way around that. There's just no other way around that. That's fantastic. All right, so now we got diversification and turnover. The yellow is a tie. The blue is for in favor of Vanguard. At this stage, it's pretty much the same. Turnover is pretty low across the board. Huge amounts of holdings. Yeah, so that's a wash. Tracking error is pretty doggone close across the board. We're talking literally 1/100th of basis point difference here. So that's just not a big deal. Diversification. Let's see. Yeah, man. I mean, you're talking minimal stuff here. All right. I mean, look at this. Tracking error, here's we're talking 0.01 here. I mean, it's a little bit different there. So tracking error, the Vanguard Communications. But I mean, this is the thing. Why would you get a Vanguard Communications ETF or a Vanguard Consumer Staples ETF or a Fidelity Consumer Staples ETF? I mean, don't do that. That's active trading stuff. So and don't do that. I mean, you can, I get it, but here the Vanguard's 0.04 is a tracking error. Here's Fidelity's 0.03. I mean, but come on, man. It's a tracking error based on the S&P 500. It's tracking to an actively managed index anyway. I presume it's the S&P 500. All right, so let's make this a little bit smaller because that bores me. I'm going to look at bonds. There we go, bonds. No, that's real estate sector. Domestic stocks. So Vanguard smokes some domestic stocks. It means Fidelity's are a little better at before tax returns, and Vanguard are a little bit better after tax returns. In general, for the before tax return, it's hard to say who the winner is, but for the after tax return, Vanguard is clearly the winner. Vanguard research has shown that of all the expenses investors pay, taxes can take the biggest bite out of returns. Most mutual fund managers are not concerned with the tax implications of their trading, and Vanguard wins in that. Vanguard is much more tax efficient than Fidelity. I mean, that's all you need. The cost Fidelity is a little bit cheaper than Vanguard, but nothing. All right, I just want to talk about bond funds in here. The best stock index, okay. Yeah, and here we're talking what the indices are. I guess they don't talk about bond funds. That's weird. All right, well, they don't talk about bond funds. They just talk. I'd like to see the bond funds. And this is out Roth. Okay, so here's number 7. All right, interesting. Concise summary of the comparison. The number of blue cells wins, and Vanguard had 31 before tax. Fidelity had 26. The average differential between Fidelity and Vanguard, the number of Fidelity winning funds at 12. It just that was interesting, but I would definitely. That's not that interesting. I'd take. I thought it'd be a little bit more. I thought there'd be more to it. I'd take Vanguard just because, again, we see these blue across. Look at that, and it's just blue, 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 blue for 1, 3, and 10. We can't go to 10 because Fidelity doesn't have a 10-year track record. So there you go, my friends. If I'm choosing between index funds, I'm still going Vanguard, even though Fidelity has done, a pretty good job reducing their fees and making it competitive. But I'm still going Vanguard. We'll see you.